It's funny, right? The financial world just loves its little secret codes. These acronyms just kind of pop up, and then all of a sudden everyone's throwing them around like they've been speaking this language since, well, forever.
Yeah, like it's a secret handshake you gotta know or you're out of the club.
Exactly. We saw with IPOs back in the day, ETFs.
Yeah.
Heck, even YOLO had its 15 minutes of fame during that whole meme stock mania.
Yeah, YOLO. I kind of miss those Wild West days sometimes.
I hear ya. But hey, get ready, because they're a new kid on the block, or maybe I should say a blast from the past, making a comeback with a whole new set of serious implications. We're talking DOGE.
DOGE, huh? Yeah, I guess that little Shiba Inu dog is probably still bouncing around in some folks' heads.
Yeah,
And of course, who could forget the whole cryptocurrency craze it kicked off?
right. Started as a joke, but ended up, well, not exactly a laughing matter for everyone. And just to add another layer to this acronym soup, we now have the Department of Government Efficiency also decided to borrow those same four letters.
Yeah, this is definitely going to cause some head scratching out there. Talk about an identity crisis.
But here's where things get really interesting, at least for our deep dive today.
Yeah.
So for now, let's just set aside those memes and the whole crypto world for a second, because the DOGE we're really zeroing in on, especially as this first quarter of the Jubilee year wraps up, is something much more fundamental, something every savvy investor should have on their radar.
Right, got to get down to brass tacks.
Exactly. So we're talking debt, oil, gold, and equity. That's the real DOGE we're dissecting today.
And let me tell you, now is the perfect time to be looking at these four pillars, really. They're all interconnected, like vital signs for the economic body, if you will. And when one of them starts acting up, well, it tends to send ripples through the rest. And those ripples, my friend, those are what we're going to learn to read today.
Could have said it better myself. So if you're out there listening, trying to cut through the noise and figure out what really matters for your investments right now, well, you've come to the right place. Let's get down to business and unpack this real DOGE, starting with, well, probably the elephant in the room, debt, specifically the U.S. government's spending habits. And we can't talk about that without mentioning this new Department of Government Efficiency, DOGE version 2.0, as you might call it. They're promising to tighten the belt, cut the fat, all that good stuff.
Sounds promising, right?
It does. But let's see what the numbers actually tell us, shall we?
Yeah, sometimes those numbers tell a different story.
And how.
Yeah.
So February rolls around and the U.S. government spends, get this, $603 billion. That's a whole 6% jump from the $567 billion spent in February last year.
Oof, that's a hefty increase.
You said it. Meanwhile, the money coming in, the tax revenue, it was only $296 billion. So you don't need a fancy calculator to see that we're talking about a $307 billion deficit for just 1 month. That's right. Tax revenues couldn't even cover half the bills for February.
Yeah, and if we want to connect this to the bigger picture, that February shortfall pushes the total deficit for the first 5 months of 2025 to, are you ready for this? $1.147 trillion. And get this, that's already 38% of the entire fiscal year's spending gone. And we're not even halfway through the year. What this record deficit really tells you is that the traditional safety net of government spending during economic downturns, well, it's getting stretched pretty thin.
And that's got to make you wonder what options they'll have left in the future when things get rough.
Exactly.
And here's where things get really interesting and honestly, a bit nerve-wracking for the country's long-term financial health. That $1.147 trillion, that's the biggest deficit we've ever seen in the first 5 months of any fiscal year, any year.
Bigger than.
It's even bigger than the crazy spending spree we saw right after COVID hit. And hold on, folks, because the debt story doesn't end there. On top of this massive ongoing deficit, Uncle Sam's got another, about $8.7 trillion in existing debt that needs refinancing.
Okay, so add those two together, and what are we looking at here?
Oh, let's just say the U.S. government is going to have to issue almost $10 trillion, that's trillion with a T, in new debt in the next 9 months.
Wow.
Yeah, wow is right. That's over $1 trillion every single month. It's almost impossible to wrap your head around a number that big.
It is. It is.
And of course, all that borrowing comes with a hefty price tag. In those first 5 months alone, the U.S. shelled out $480 billion just on interest payments. That's another record, folks. And here's the kicker. It's more than 3 times the amount the Department of Government Efficiency says they've saved since January.
Yikes.
Yeah, it's like trying to outrun a treadmill that's constantly getting faster.
Definitely makes you wonder, right? Wonder about the long-term sustainability of all this. Can we keep kicking that can down the road forever? And what happens if we can't?
Right. And what are the implications for, the economy for everyday folks like us, big questions.
Mm-hmm.
All right, so let's take a step back for a second and think about how this mountain of debt affects us as investors. Remember that famous line from Alexander Hamilton? He said, national debt can actually be a good thing, a blessing even, as long as it's not excessive.
Famous last words,
Well,
right?
it does make you wonder if we're maybe uh, tiptoeing pretty close to that excessive line right about now.
Yeah, maybe. For a long time, especially after World War II, U.S. Treasury bonds, those were seen as the ultimate safe haven, the gold standard of risk-free assets. It all had to do with the U.S. dollar, being king of the global trade hill. Countries running a surplus with the U.S., well, they'd basically take those dollars and park them right back into U.S. debt. It was like this perfect self-sustaining system.
Yeah, it was seen as the safe bet, the no-brainer.
Yeah, exactly. But as with everything, times change.
Oh, they do. We had the whole great moderation thing under Bernanke, then bam, 2008 hits, and we're suddenly in the world of quantitative easing and all that jazz. I think that's when people started getting a little suspicious, a little less sure about those U.S. Treasuries being the foolproof, risk-free haven they were always made out to be.
It was like a crack in the facade. Made you wonder what was really holding it all up.
And then across the pond, we had Mario Draghi in Europe with his whatever it takes moment. It calmed things down, sure. But it also, kind of exposed the fact that even sovereign debt, even the big guys, can have credit risks. And let's not forget what happened in 2022, the whole weaponization of USD assets.
Yeah, that was a game changer for a lot of folks.
We're talking about freezing assets, using the financial system as a tool, a weapon, really. It sent a pretty clear message. Holding treasuries. Well, it wasn't the same safe bet it used to be, at least not for everyone.
Yeah, and all that has real consequences. We've been seeing fewer and fewer foreign investors holding U.S. debt since that 2008 crisis. Like, they're not so eager to keep funding our little spending habits anymore.
And it's not just about who is holding the debt, it's also about what we're getting in return for all that borrowing. Apparently, for every new dollar of debt, we're only getting back like 50 cents in GDP growth. That's not a great return on investment, is it?
Not exactly a booming business.
Nope. And to top it all off, those interest payments, they've become the second biggest item on the federal budget. Think about that for a second. Second only to, like, I don't know, defense spending or something.
Definitely give you pause.
It does. And it all feeds into this thing called negative real interest rates.
Yes. That lovely little phenomenon.
So for those who aren't fluent in econospeak, what negative real rates basically mean is that the interest you're getting on those government bonds, well, it's actually lower than inflation.
Yeah, so your money's technically growing, but its buying power is shrinking.
Exactly. It's like the market saying, hey, the future is so much more certain than right now. Which, last time I checked, doesn't really make a whole lot of sense.
It's a bit upside down, you could say.
You could definitely say that. And
Yeah.
it kind of hints at a strategy some governments might be using, just quietly inflating their debt away, making it worth less and less over time.
And if that's the game, well, holding on to those long-term government bonds might not be the smartest play anymore.
All right, so we've talked a lot about debt, and it's a bit heavy, right?
Yeah, it is.
So let's switch gears to something a bit more tangible. Let's talk about oil.
Oil, good old black gold.
Yep, we often hear it called current energy, which I think is a nice contrast to our next topic, gold, which you could think of as stored energy.
Like a battery, ready to go when you need it.
Exactly. And historically, there's been a pretty clear link between the prices of these two. Before 2015, if you had an ounce of gold, you could trade it for, I don't know, somewhere between 9 and 20 barrels of oil. But since 2015, things have shifted. Big time. Now that same ounce of gold can get you 20 to 40 barrels.
Yeah, that's a pretty dramatic swing.
It is. So what's going on there? What's driving that change?
Well, part of it is how people view gold, especially as a safe haven asset. We'll get into that more in a bit. But there's another thing to keep in mind. Historically, whenever we've seen those big, nasty bear markets, they've often happened when the ratio between the S&P 500 and the oil price drops below its 7-year moving average.
So that ratio is like a canary in the coal mine.
You got it. When that ratio dips, it usually means the economy is having a hard time turning energy, turning oil into, well, economic growth into profits. And when that happens, things tend to go south.
Makes sense. So where does that ratio stand right now? Should we be battening down the hatches, expecting a big market crash based on oil prices?
Not just yet. Right now, that S&P 500 to oil ratio is still well above its 7-year average, like more than 30% above. So while the gold market might be flashing some warning signs, the oil market isn't exactly screaming crash just yet.
Interesting. Okay, so let's move on to that stored energy we talked about, gold. Now, we've touched on this a bit, but why are investors flocking to gold, especially these days?
Well, as we said, smart investors, they start looking to gold when they get that uneasy feeling about those supposedly safe and sound government bonds. They call it counterparty risk. Basically, if you start to doubt whether the issuer, in this case the government, can actually pay you back, well, you start looking for alternatives. And gold, with its long history as a reliable store of value, well, it starts to look pretty darn good.
Especially in times like these, right? We've had high inflation for a while now, and historically that's always been good news for gold.
It has. But gold's role is changing. It's going beyond just being a hedge against inflation or wobbly real estate markets. It's becoming a shield, a protection against something much bigger, much more fundamental. We're talking about the possibility of those fiat currencies, those dollars and euros and yen losing their value, maybe even collapsing completely. And then there's the whole issue of asset confiscation, governments using the financial system as a weapon.
Right, like we saw in 2022.
Exactly. So in a world where those contract assets, those IOUs like cash and bonds, they start feeling less and less secure. And that's when people turn to ownership assets, the things you can actually hold, like equities and gold. And gold, well, it's like the king of those ownership assets, the ultimate store of value, the thing you cling to when the storm hits.
Makes sense, especially for folks who've, seen this happen in emerging markets. They've known this for a long time.
Oh, absolutely. They've lived through it.
Now, you mentioned that gold can also be used to figure out how attractive stocks are.
Mm.
How does that work exactly?
Well, we look at the ratio between the S&P 500 and the price of gold. We compare it to its 7-year moving average. Think of it like this. When that ratio is above the average, it usually means stocks are on a roll, a bull market. People think stocks are the place to be, offering more growth potential than safe haven assets like gold.
So what's that ratio telling us right now?
Well, it's actually dipped below its 7-year average since, well, let's just say since the disruptor-in-chief took office. And that suggests we might be in a structural bear market for U.S. equities. In other words, gold's looking pretty good compared to stocks right now.
That's definitely something to think about. And it makes sense when you look at gold prices globally. It seems like they're hitting record highs in every currency, right?
That's right. Doesn't matter if you're looking at dollars, euros, yen, Swiss francs, even the Chinese yuan, gold's been breaking records across the board. It's like this global vote of no confidence in, well, in all those paper currencies out there.
Speaking of China, you mentioned that the Chinese yuan and their government bonds might become a safe haven in the future. How does that fit into this whole DOGE analysis?
Well, it's interesting. From about 2014 until COVID hit, Chinese government bonds in yuan, they actually did a decent job as a store of value. And right now, with their long-term interest rates still pretty low and gold expensive compared to energy, those Chinese bonds and gold, they're looking pretty anti-fragile, you could say.
Anti-fragile, that's a new one.
Yeah, it means they don't just survive chaos, they actually get stronger from it.
Okay, I like that. So they thrive on a little bit of disorder. Now, you also mentioned a bit of a wild card scenario with, well, the Department of Government Efficiency, the other DOGE. How might they shake things up?
Yeah, so there's this hypothetical situation, right? Imagine a future Trump administration, and they actually managed to pull off those big, bold Austrian school economic policies through this new DOGE department. Now, if they really get things humming, if they manage to significantly boost U.S. productivity, even after some initial bumps in the road, well, that could actually cause a dip in the price of gold.
So a really successful DOGE, the government department, might actually make DOGE, the investment, the debt, oil, gold, and equity, less attractive.
It's not impossible, but, there are a lot of ifs in that scenario. It's all pretty uncertain. So for now, gold's still a top contender for that anti-fragile title, especially with all the geopolitical tension out there and what some folks are calling the forever banker wars.
Okay, so let's wrap things up with equity, with stocks. We talked about how that S&P 500 to gold ratio might be hinting at some choppy waters ahead for the stock market.
Right. And when you look back, those really brutal bear markets, the ones that really bite, they usually happen when both the S&P to oil ratio and the S&P to gold ratio take a nosedive at the same time. It's like a 1-2 punch that knocks the wind out of the market.
And we talked earlier about how that S&P to oil ratio is still pretty high.
Yeah.
So it's that difference, that divergence between what gold's telling us and what oil's telling us that's really interesting right now.
It is, and it makes you think about how the challenges facing those big industrial economies have shifted over time. Back in the day, the problems usually came from the private sector, things like wars or taxes. But since we kicked off this decade, the main headwinds seem to be coming from, well, from the public institutions, from governments. It's like a loss of confidence in the system, coupled with all this government spending that doesn't seem to be making people's lives better or really boosting the economy.
And in that kind of world where you've got negative or barely positive real yields on those traditional bonds, well, the old ways of figuring out how much a company's worth, all those fancy calculations and models, they just don't seem to work as well anymore.
They don't, because that risk-free rate,
Yeah.
that bedrock of all those financial models, well, it's not really risk-free anymore. And when you factor in inflation, trying to predict what those future cash flows are going to be worth, it's like trying to predict the weather 3 months out.
Good luck with that.
Yeah.
So what's an investor to do with their stocks in this crazy environment?
Well, the name of the game now is return of capital, not just return on capital. When you're facing stagflation, slow growth, and high inflation, the first priority is protecting what you already have. That means finding those companies that aren't drowning in debt, that have steady earnings, and are generating solid free cash flow. Sectors like energy and commodities, those might start looking pretty good too.
So a little bit of caution and being picky about which stocks you hold, that's the way to go right now.
Absolutely. Can't go wrong with a healthy dose of prudence.
All right, so let's bring this deep dive into the real DOGE, debt, oil, gold, and equity, to a close. It's been a wild ride. We've seen how the U.S. government's finances are looking a little shaky, despite all the talk about efficiency. And those U.S. Treasury bonds, that supposedly unshakable foundation of the financial world, well, people are starting to have their doubts.
Yeah, cracks are showing.
They are. And then there's gold. It's stepping up, taking on a bigger role than ever before. It's not just about hedging against inflation anymore. It's about measuring real value, protecting yourself from currency chaos.
It's like the ultimate insurance policy.
It is. And while oil prices aren't screaming stock market crash just yet, those signals from the gold market, they're definitely saying be careful out there. And that gap, that divergence between oil and gold, it just highlights how important, how crucial gold is in this crazy economic landscape.
Right. The takeaway here, the big one for you as an investor, is to make sure you get your money back. Those old school ways of thinking where you just assume government bonds are safe, well, those might need a serious overhaul.
And that brings us back to those anti-fragile assets, the things you can hold, like good old-fashioned gold and silver. There's no counterparty risk with those. You know, there's that famous Einstein quote. He said, two things are infinite, the universe and human stupidity. And I'm not sure about the universe.
That's a good one.
Yeah, it's kind of dark, but it's also funny in a way. And it makes you think, you know, it makes you think about holding on to those tangible assets, things that have real value as a way to protect yourself, not just from governments messing things up, but also from, well, from everyone else kind of losing their minds.
And when you look around, when you see all the uncertainty out there, when trust in institutions is eroding, well, it's hard to argue with that logic.
So here's a final thought, something to really ponder as we finish up today. Given everything we've talked about, this whole real DOGE situation, what does it mean for you, for your own long-term investments? Do you need to go back to the drawing board and rethink how you're allocating your assets? You know, those old models, they might not cut it anymore in this ever-changing, unpredictable world we're living in. Something to think about as we navigate the rest of this Jubilee year, and whatever surprises lie ahead.
Food for thought.
That's what we're here for. Until next time, folks,
Happy investing.
and stay anti-fragile.